All right, Louis, you ready?
Yeah, we're ready to go here. I'm going to just jump to the next thing.
Yep. Okay. Hey, welcome everyone. We want to thank you for taking the time out to be with us today at Ogletree Financial's Wednesday webinar. We got quite a few on the call today. We are recording it, so if you're not able to catch the tail end or something, we will get that out to everybody. But just to let you know, my name's Doug Mitchell, and my partner Louis LaBache here is going to do the presentation for us today. What we are trying to accomplish by doing these webinars each week is to give you guys a taste, if you're not already doing business with Ogletree, give you guys a taste of what we bring to the table. And, you know, one of the things that we just got back from a North American conference out in Las Vegas, and so one of the presenters out there talked about a book, The Blue Ocean Theory, or Blue Ocean Strategy. I just kind of wanted to touch on that a little bit because it really came close to home, and it kind of reminded me of how Louis and myself operate. And it's, you know, we're not in that red ocean swimming around with the sharks out there competing against term rates and, you know, competing against other brokers, because what we're doing is we're showing you guys concepts, and we're taking you to places that there really is no competition. You've just got to go out and talk to prospects and educate them and get them involved. And with the tools that we have, the video that we just showed up front is a great way to introduce clients to bonus executive bonus plans. I don't think the audio is working, but when we send out the recording, there will be a link so that all of you can take a look at that video. And Louis is going to tell you a little bit about the video and how you can get your own copy of that here when he gets started. Our phone number is on the screen, 800-466-8186, extension 1 or 2, so we can talk to you a little bit more about that after the workshop. But what Louis and myself bring to the table for you guys is we try to get you out of the competitive waters and into that blue ocean to where you're bringing valuable ideas to the table to these clients, and you're not really concerned about what other agents are out there doing. So this is just another great example today of how you can kind of separate yourself from the other agents out there. Couple things I wanted to mention. We have a company trip every year. This year it's going to be to Cancun, to the Riviera Maya area. And it's a Now Sapphire resort. It's an all-inclusive resort, and we've got a very easy convention to qualify for. It takes $50,000 in target premium. So a lot of you guys out there are writing $50,000 target cases in just one case when it comes to executive bonus plans. In addition to this contest here, this kind of piggybacks on a couple of other contests we have, because whatever you write, doesn't matter what company you write with us, all of the premium is combined, and when it adds up to $50,000, you and a spouse or a guest make the trip. We just got back from Las Vegas with North American to their convention. Next year it's going to be in Scottsdale, Arizona. So, and I think the number is 32,500 to write for there. So basically a few cases. And what that gets you is that we're going to fly you over to Scottsdale. You'll have a room and all your meals and cocktail parties and entertainment and all taken care of. But in addition to all of that, you're going to have a couple of days to meet with North American, listen to the speakers that they bring in, learn more of these sales concepts and ideas. So just a wealth of information. We're trying to get you guys to where we used to be one day, long ago, when we had training with our career agencies on a weekly basis. So the more information we can give you, we feel the better you're going to go out there and make sales. So Louis, why don't I hand it over to you and show these guys what we've got in store for them today on the executive bonus program.
Okay, great, Doug. Okay. My name is Louis LaBache, and today we're going to talk about a concept of executive bonus and how this works And part one of this whole presentation is going to be talking about this Section 162 of the Internal Revenue Code. And essentially what it does is it says that bonus compensation is tax deductible as a business expense. So a business owner or C corporation could pay a bonus to their key employees, and any money they pay them is a tax deductible expense. It'll be just like a salary increase, or handled the same way as that. So it's a tax deductible expense. So basically what we want to do though is that help these business owners be selective and be discriminatory, so they can actually target certain key employees and keep them on board, and essentially it's the highly compensated ones, the most important ones to their business, that this is a program to help keep those folks, so to speak, in the fold with the company. So and this is why they call it executive bonus programs, right? So the idea behind this is that they can give them the money, and they can do whatever they want with the money. In all actuality, we're going to show them some compelling reasons why they might want to buy them a life insurance policy, and help nurture this, keeping them around until retirement to help contribute to the business. So the second part of this thing is the supplemental employee retirement program that is built with the life insurance policy. So the idea behind this is that they don't just want to give them the $10,000 or so, whatever the bonus number is, so they can just take that, go buy a boat or a new car, or make a down payment on a new car these days. But essentially want them to take that money and put it into a program that's going to provide them with a retirement program, and you're going to give them the money every year as long as they continue to work for you. So that's the idea. So they get a permanent life insurance policy. It has tax-deferred growth in the policy, along with the annual reset built into the policy, the Index Universal Life. It has penalty-free access to the capital. So they put this money in the program, and say 5 years from now something happens and they need some money, they can get the money if they need it. So the idea behind this is not they can give them the same money, they can put it into, say, a qualified plan like a 401k plan, but they can't get to the money without penalties or jumping through hoops to do this. Whereas with this, they can put it in there. Then they also get tax-free retirement income from this program. And this is the big hook, the reason why they would want to buy the insurance policy versus just handing them the money so they can go do what they want with it, right? And the biggest part of the policy, and this is one of the things we're going to talk about a little bit today, is that these policies are unique, and the one thing that they offer that nothing else, no other place they can put their money has, is this opportunity to participate in the arbitrage when they take the money out. And we're going to talk about that. And this is one of the strongest points of these policies that make these things work so well. And we're going to talk a little bit more about that going forward. So WIFBO. WIFBO means what's in it for the business owner. And so in order for anything to work, the business owner needs to have some skin in the game and basically understand why this is going to work for them. So first of all, it's for the retention of valuable employees. I mean, they don't do these executive bonus programs for anybody. It's the idea is that they can be discriminatory, and they want to get their favorite employees, the ones that are contributing the most, and the ones that are at most risk to leave because they're highly compensated, but they're also because they're highly competent. Okay, so the idea is that they want to keep the employees around, and that retains the business knowledge that they have, so they don't have to retrain anybody. I've worked in corporate America myself before, and I've gotten promoted, and I've also taken over jobs that people have left. Okay, and the promotion works something like this: you go see the new guy, or you go to take your position, and the guy that was there before takes about 15 minutes to tell you everything that he ever did that needs to be done, and see you later, and he's off on his own new adventure. So that causes a big problem. So even getting promoted is not a good thing in many corporations, because they don't really have a good way of transferring the responsibilities in a lot of cases. But if somebody leaves, there isn't even a guy to ask what happened. And lots of times when they leave, they also take clients, they take information, they take data, they take everything that they were working on out the door. And most people, when they leave, they don't go work for some other kind of company. They generally go work for a competitor. And this whole idea is to keep these valuable employees around. Also, it helps them, if you have them around, it's more reliable. Everything's more reliable. They understand what's going on. There's a continuity. Also, the client relationships and the customer relationships, it's one thing to have a turnstile of say sales reps in a company, and every day the customers have to learn who the new person is to talk to. That doesn't bode well for building businesses or building business going forward. So by having these valuable employees retained, they know the customers, they learn to work with the customers, they understand the customers and the clients, and help build the business even more. And then there's this internal continuity that's needed, because again, when that person leaves, there's all of a sudden this big empty office with a whole bunch of unfinished duties that need to get done, but how do you pick up the pieces and get it done? So that by the person not leaving, everything just keeps on running smooth as can be. And it enhances productivity because of that. And then the other part about it is that this bonus is a tax-deductible business expense. So it's something that, there's some incentive here, even though it's going to cost them more than what they save in taxes to do this, it still helps them understand why this might be a good idea to do this. So they have the business expense built into the thing, all right? And the nice thing about this is the plan can be customized for each executive. They don't have to give everybody the same thing, like some qualified plans where they're kind of stuck with everybody has to get the same thing. Here you can pick and choose, and the more valuable the person, the better opportunity you can give them. And the nicest thing about this after the fact, once the plan is set up, there are very low administration costs, okay? All they got to do is take a check and stick it in an envelope and pay for the stamp. Everything else is taken care of by the insurance company. They don't have to pay some TPA $1,000 or $2,000 or $3,000 or $4,000 a year to administer all this stuff and also make sure all the papers go out at the right time and et cetera, and leave themselves open for all types of liability. They don't have to have that problem because all they need to do is just pay the premium and it's all taken care of. So how does it work? There's one of two ways you can do this. The executive basically owns the policy in both cases, all right? The insurance company can receive the money directly from the corporation to pay for the policy, or the company can pay the employee and the employee pays for the policy. Whichever works for them. Probably from our point of view, we would want to have the company pay the premium directly to the insurance company. The company would probably want to do that too, because that would make sure that the policy is going to be continued in force. It's going to serve the purposes that they intended it to do, and also it makes it a better benefit for the employee that they don't have to touch the money and have the opportunity to spend the money or do something else with it, and it continues on with the whole plan. So that's how it works pretty much. It's pretty simple. Basically, it's a matter of getting a life insurance policy on an employee. The employee owns the policy. They're the insured. They own the policy. They own everything about it, and the corporation pays for it in the way of a bonus. Now, what's in it for the employee? Well, first of all, they get some family security because it is life insurance. They might get a feeling of appreciation. This is a bonus. This is something that they're special, that they've gotten some reason to tie them more so to the company. It provides them with higher income at some point in time. So it's just more income for them. And the supplemental employee retirement plan can provide them with a lifetime income of tax-free income. And it can cost the employee nothing for all of this. And how does that work? Well, it's pretty simple, right? This is a little calculator I just built, and I just threw this together today, actually. But here's an employee getting a $10,000 bonus. And as an example, say the employee's in a 28% tax bracket. So this would be somebody who's making $150,000 a year or so, could be in a 28% tax bracket. The corporation, if they're over $100,000 in earnings, they're like in a 39% tax bracket nowadays. All right. So the corporation pays this $10,000 premium, and because the employee's in a 28% tax bracket, he'd have to pay $2,800 in taxes on that if he had no bonus. Okay, but if the employer actually bonuses him, what they do is they pay $10,000 to the insurance company, and they give the employee $2,800 and a 1099 for $12,800. They essentially have paid the tax for him. But because they gave him $12,800, there's more tax involved. So what they would do is that the employee would be stuck to paying the taxes on the $12,800 on the $2,800 because he had enough to pay on the $10,000. But he actually got $12,800, so he'd have to pay $1,089. So the other side of the coin is that the employer could actually go ahead and double bonus them. And the way that works is that they pay the $10,000 premium to the employee, to the insurance company, and they give the employee $3,889, And that $30,889 is enough to pay all the taxes on the $10,000 or on the $13,889, and it's costing him nothing. And for the employer's point of view, he's in a 39% tax bracket. If he does it this way, this thing costs him $7,800 for this program, and over here it costs him $8,400 for the program. So this, and if the program was going to be $12,000, basically all the numbers change, but it essentially does the calculations for you. Or if the employee's in a higher tax bracket, all the numbers change again. But essentially the way it works is that the double bonus is probably the best thing for the employee, and the employer gets to get the deduction on the whole amount of money that they put out there. So that's how it would work essentially. All right? So double bonus means employee pays nothing. The single bonus, he pays a little bit of tax. No bonus, he pays the tax on the whole amount himself. So could be multiple ways to do this. But what it does for both of them is it promotes the business owner and the employee partnership kind of program. They're in this together, so to speak. Enhances productivity, promotes employee job satisfaction, and also provides what I call the best retirement program of the 21st century. So this is the big hook. The reason why the employee would want to stay in this program is because now he's not only taken care of while he's working because he has a job, but he's also going to be taken care of after he retires. Okay? So we found the money now. So we've got the employer to put in the money, and that's where it comes from. It's just a tax deduction. He just writes a check to the insurance company, as simple as that could be. All right. So we found the money. So what are we going to do with it? All right. So what we're going to do is we're going to purchase a max-funded index universal life policy. All right. And this policy is going to be designed so we're going to buy the least amount of coverage for the most amount of money. So those of you that have sold universal life in the past, and the way universal life, a lot of people say, well, that stuff crashed and burned, but it was sold originally for the most amount of insurance for the least amount of money based on maybe an 8, 9, 10, or 12% projected return on the cash account. And that's why they fell apart, because they were paying as little as possible to get as much as possible. We, on the other hand, are going to pay as much as possible to get the least amount of insurance and still make it an insurance policy. And that's why this thing works so well. So we're going to buy this insurance policy. So remember, it's $10,000. So basically what we have is we have this key employee. He's 45 years old, and he's in pretty good shape. So we're going to get him this policy, and he's a preferred non-tobacco risk, basically. And that means that he gets a $204,000 death benefit policy for this $10,000. And the way I've allocated the savings in this policy, and I've been very conservative along these lines, is that basically what I've done is I've said 50% of the money is going to go into the annual point-to-point index, the S&P 500, all right? And we're going to take the other half and we're going to stick it in the fixed account that's paying about 4% right now. So at the end of the day, we've got 8% projected over here, and half of that's going in there, and half of it's going in the 4% account. So when you do it, put them both together into a composite projection, we're projecting like 6% growth overall for the foreseeable future on this policy. So he puts $10,000 a year in, and we're continue to contribute this until this guy gets out to retirement age, and you'll see the numbers that we plugged in there. And then it goes on, and when he gets to retirement age, at age 67, as last year he works, a 45-year-old has to work to 67 to get the full Social Security benefits today. And the policy says that he can then take $45,000, almost $46,000 a year out of the policy all the way until age 100. And I just want to point out right here, we're going to put $220,000 into this policy that the employee owns. And if you look here at age 67, basically, the cash value, the guaranteed cash value, which is, this is assuming that the market went downhill every year for the next 22 years. The guaranteed cash value at that point in time is $221,000. So there's actually $1,000 more than was put into the policy. It's a full return of premium for this 45-year-old, again, and that's guaranteed. That's the worst that could happen here. And he actually has a death benefit at that time of $651,000 at age 67. Yeah, and this is a pretty big number going on through this whole deal. So actually, we have this continue on. The 45, 948 goes all the way to age 100, and you can see that. And a couple things that I'm going to point out here, like at age 80, there's still $290,000 in life insurance, right? And we get out to age 100, and there's that's now grown to $700,000 life insurance, and we've taken $1.5 million out of this policy over all that time period in the form of tax-free income. So that looks like a pretty good deal, but in the mind's eye, the guy might say, well, I don't want to pay any tax. I'd rather take that $10,000 and stick it into my 401k plan and the bonus too. I can put all that in there and I don't pay any tax and I'll get better. I'll get a better deal. In his mind, that's what he thinks, okay? So let's just take a look at this. So what we're going to do is we're going to go to the software program that we have called the Last Great Tax Saver. And this is the Ogletree software package, the calculator toolbook that everybody gets that becomes appointed with Ogletree. And essentially there are 14 calculators in here. We have a calculator that I call this one How to Rob a Bank, which basically shows you how to compare the lifetime income riders and annuities to CDs. Easy as 1, 2, 3 is already a canned, ran 5 illustrations, a 35, a 40, 45, a 50, and a 55-year-old, all saving $10,000 a year. Compare it to a 401k plan at 6%. And show them how they can get 300, 400, 500% more money, just depending on how old they are. The younger you start, the more you get than you will out of your 401k for the same money, right? There's a retirement planning program to help you understand how you're doing, and there's also a wealth transfer program that shows you even with AG 38 coming upon us, guaranteed UL products for the better companies are still excellent products for wealth transfer, and people can get guaranteed, if they live the life expectancy, they can get returns on their premium dollars in the teens, okay? Guaranteed that they can get that. So basically, those are the programs that are in here. So I'm just going to jump to the software. And we're going to go right to the Last Great Tax Saver. And what the Last Great Tax Saver does is it's going to say, okay, let's just take a look at this program, Mr. Client, that we're talking about, this retirement program, and let's just see if there might be some better options for you than what we have to offer here. So first of all, remember we said it was going to go at 6%. So that's what the projection was. And he's 45 years old, and we were basically going to put in $10,000 a year into the policy, okay? That's what the employer was going to put in there. And he was going to do it for 22 years, and in the 23rd year, when the person retired, he could actually take, in the projections of the policy based on 6%, $45,948 a year out of the policy. Right? So basically, and he did it for 33 years, and we're assuming he's in a 25% tax bracket now, and we're just going to assume that, this guy, he's a high flyer, he's doing pretty good here, he's a prized employee, and so he's probably going to do better in the future. We're just going to assume he's going to be in a 30% tax bracket, but he could be in a 25. We can change the numbers. He could be in a 40, he could be in a 20. So we're just going to leave it at 30 because that's where most people think taxes are going to go up, and they have. So essentially, he puts in $10,000 now, he takes out $45,000. So this is what it looks like. $10,000 a year for 22 years, and then he takes out $45,000 for 33 years, all the way to age 100. So he's year 55, he's 45 now, 55 years from now he's 100, okay? So that's pretty much how that works, and that looks good. Small numbers here, big numbers here, but is that the better place to put his money? In the back of his mind, he's thinking, that tax deferral with that 401k plan, that might be a better place to go. So we just click on this, and what we're going to do here is we're going to show that currently we say he's in a 25% tax bracket, and that means that if the employer gave him $13,333, okay, he would have $3,300 to pay the taxes and $10,000 to do something else with. So we're going to take the whole $1,333, and we're going to stick it in his 401k plan, right? And we're also going to run it at 6% because, we're just trying to be fair. And 6% here, 6% there. Actually, when you think about it, this money, for the most part, is tied to the S&P. Matter of fact, it's even partly tied to the S&P. Half of it's in a fixed account. And so that being said, we're going to put all his money in the S&P, take advantage of all the great things that the market's going to do, or whatever stock market he's going to put it in, and ups and downs. And we're going to just assume that he's going to get 6%. I'm just going to click, and this is his account. He starts out with 13,333, and then it grows at 6%, just keeps right on going. He gets up here, and he's got $600,000 when he retires 67 years from now, right? That's pretty simple. And then when he takes the money out, you'll see he's putting in $13,000 versus the 10. The gold is the life insurance policy. The blue is his new 401k plan. He's plugging this in, and then when he goes to take the money out, the big difference between these two plans is that one thing is that, first of all, to get the $45,000 out of the life insurance policy, you just ask for it and it's tax-free, okay? But to get $45,000 out of the 401k plan, if you're in a 30% tax bracket, you have to take out $65,000 every year. Well, if you take out $65,000 a year, all this money here, this blue that's above the gold, this is all the money that you have to take out to give to Uncle Sam for taxes. And the idea being is that if you have to take all this money out of the plan ahead of time, it's not over here to take care of you later on, and you run out of money. As a matter of fact, this guy runs out of money in the 35th year. That's the last year that there's money, okay? And so he's age 80, and he's run out of money in his 401k plan, whereas the life insurance policy just keeps right on going. Again, both are running at 6% projection, okay? But the big thing is the taxes here and a few other things that are going inside the policy that don't happen here, all right? But that's just one place he can put his money. Now, you know, there's another place he can put the money. He could actually take it home and stick it in a mattress. I don't do mattresses in any of my calculations, so that's something that you'll have to do on your own. But essentially, the other places, again, you could actually maybe put it in a CD. Well, that's, you know, they're paying about 1%. That won't do much good, will it? All right. You might try an annuity. Well, annuities, you get no tax deferral for putting it in, so you don't have to, you just have to pay the $3,000 Uncle Sam in taxes, take the $10,000, put it in the annuity, and then when you take it out, it's taxed very similarly. You take out all the profit first, and then once he hits basis, he starts paying less taxes. He needs less money to get it out. But the bottom line is that he runs out of money pretty quickly. And CDs, I got this annuity paying 5%, which is a pretty good number these days. You know, so that's, you know, probably not a good number for him to. You can try tax-free bonds, and again, you get no deduction for putting it in, so he'd have to pay the tax on the, you know, to Uncle Sam and have the $10,000 left over, just like the policy, except that the bonds are only paying about 3.5%, and at that rate, you know, 3.5 doesn't compete with 6, no matter how you look at it, and it runs out of money very quickly. The last option is, as he could possibly do a Roth IRA, but in his case, he's 45. He can only put $5,500 in his Roth. So by putting $5,500 in, well, 55 can't compete with 10, and I gave him 5% on the Roth, which is a pretty good number, but he runs out of money very quickly because it's, you know, you can only put in about half as much. Right? So in summary, we look at this. These are all the options that he's got, except for the mattress. Remember, we don't do mattresses here. But except for the mattress, we've got, this is what he would get out of his insurance policy and income over to age 100. This is what he gets out of his 401k, which is the closest one compared to all the rest of them, okay? And, you know, so the idea being is that, well, this is what he can take $388,000 more out of his 401k than he put in. Remember, he's going to put $220,000 into his after-tax, technically 22 years of $10,000 into the 401k. He gets to take $388,000 more than he put in. With the insurance policy, he gets to take $1.3 million more than he put in. And this is just the cash. We're just talking about cash flow here, okay? Let's just talk about what else this insurance policy does, right? It also includes a life insurance policy. So let's just suppose that if he bought this 401k plan today, put his 10 grand in there, 13,000 in there, and in lieu of buying the policy. Or if one guy bought the 401k plan and his partner is an associate over there bought the policy, and one guy got run over by a car, the one who bought the 401k got run over by a car the next day, all right? Well, he basically would get $10,000 because if his spouse or family would get the 13,000 is in there, but if you take it out, you have to pay the tax on it, even if you die. So he nets $10,000 versus the insurance policy. If he would have had that, comes out and pays $204,740, 2,000% more than he would have out of the 401k plan. 20 times more money, okay, on day one or day two, etc. And at age 80, remember, he ran out of money over here at age 80. So at age 80, the insurance policy actually still had $290,553 in it. So that was the death benefit. So at age 80, if this guy was just lucky enough, and I don't know if that's just going to be lucky or not, but if he at the age 80, he spent his last quarter, or he dropped his last quarter, bent over to pick it up, and got run over by a car by accident, okay, ran out of money, his family would be, he'd be okay because he wouldn't have any more bills because he's gone, but he would still have a $290,000 death benefit in the policy that would go on to the family, basically, which is a 75%, almost a 75% increase over the 401k plan. And then if he happens to keep on living, and a lot of people are going to do that these days, they're going to just keep on living. This is, the reason being is that, health things are getting improved every day and people are living longer all the time. And if he gets out to age 100, the death benefit at age 100 is that much, okay, which ends up being overall, if this guy actually could live to age 100. Now, just think about this. If he lives to age 81, with his 401k plan, he's broke, but with the policy, he gets another $46,000 tax-free. And every year after that, he gets another $45,000 tax-free. So if he runs out of money at age 81, he's still at the policy here is just continuing on. So if he happens to live, and we only projected age 100 because it can go all the way to age 120, but at age 100, if he actually made it to age 100 and passed away, the policy would still pay an additional $700,000 in death benefit after already paying out $1.2 million in cash to the client to live on. Okay, and his family would be another $700,000. So ultimately, it's 5 times more than he'd get out of his 401k plan. So when you talk about executive bonus and you say, Mr. Client, you're going to give your employee $10,000 a year, and this is why he's going to stick around. Because if you put that 10 grand in every year, he ends up getting 5 times more money than if you put it someplace else, and he puts it in the insurance policy. This is the best place for him, and you're going to do him this favor. Because he's a hard worker, and you're going to want to keep him around, and this is what you're going to do for him, and he's going to understand the value of this once we show it to him. So this is the incentive to get somebody to do this. So the idea behind this is that we can figure out all the best places to put everything, all right, and then we'll go from there. So next thing I'm going to do is going to go back, and we're going to close this thing out and talk about, this is the best retirement plan of the 21st century in my estimation. Now, I just showed you why it is, okay? And the other nice thing about this is that if you go through the entire presentation, you're talking to the business executive or the corporate owner or the business owner who's a corporation about this, and maybe you actually have prospects out there that don't have corporations. Well, guess what? Every one of those guys could do this too, because you don't have to have a corporation. The corporation only helps you find the money on a tax-deductible basis, but if you're a business owner and you're a sub-S or a LLC or just a self-employed business owner and you have money, you can buy this program. You don't get a tax deduction, but you don't have to, that doesn't make any difference, because at the end of the day, you get more money because you can take the money and put it in a qualified plan, and you see what happens. You get 5 times more this way. So the idea is that you can start out talking about a tax deductible program, but if they don't qualify or if they don't want to move forward on it, any of these people can do this plan all by themselves without the corporation. And that's where I think the bulk of your sales will come from when you do this. All right? So what does it do? First of all, this is what I call the big 3. The big 3 reasons why I like Index Universal Life so much. First of all, you get the tax deferral, just like other permanent life insurance policy, you get tax deferral. But in this one, you get this thing called annual reset. So not only do you get the tax deferral, you defer all the gains, and you get to keep all the gains. They don't go down; they only go up. So that's one of the big parts of what I call the big 3. All right. The other one is that you get tax-free income, and out of the box, we talk to people. You say, look, we have a program here that compared to your 401k plan, we can increase your retirement income by 25 to 40%, just out of the box. And they say, well, how do you do that? I say, well, first of all, you're probably in a 25 to 40% tax bracket today. You're probably going to be in a similar one when you retire. And we take away all the taxes, and we give you market-like returns. So you end up getting 25 to 40% more just out of the box. So and then at the end of the day, if you have money left over in your 401k plan, guess what? You leave it to your children or your spouse, whoever you leave it to, they still have to pay taxes on it. So there's no free lunch there. The life insurance policy, the residual money left in the policy is paid income tax-free to the beneficiaries. Right? So that's a good thing, right? And then the third thing, and this is the one thing that most people kind of miss when they look at these things, and it's not explained very well because it's one of the more complicated issues. It's called the arbitrage that's available in Index Universal Life policies that have variable loan rates. Okay. And when people hear variable loan rate, they think, oh, that's a bad thing. It's variable. It could be, could be terrible. Well, the product that we just showed you, the builder from North American, it's a variable loan rate, but it maxes out at 6%. That's the most they can charge you is 6%. So that's the highest rate, period, 6%. Currently, they're charging about 4%. Now, just to tell you just a little history, just last year, everybody that had one of these builder products that actually had their money in the S&P 500, who actually borrowed money on their product to do what? To buy a boat, to pay the electric bill, to eat, to buy a house, a second house, whatever they borrowed the money for, to go to the casino and put in a slot machine. They borrowed the money, they paid 4% interest to borrow it, but they actually still made 14% on the money they borrowed. So even though they took the money out and spent it someplace else or did something with it, they made 10% on the money that they took out. That's the biggest thing that's different between the Roth IRA. When you take the money out of the Roth, it's gone. When you take the money out of here, it's still there working for you. When you take the money out of the 401k plan, it's gone. When you take the money out of the policy, it's still working for you. So no matter where, tax-free bonds, you take it out of there, it's gone. Here, it's still working for you. And it also has the ability, some people say, well, what if the market is a down year? Well, with North American, you can actually change from a variable to a wash loan just by calling them up. So you don't have to worry about those down years. You can change back when the market picks up again. So the idea behind this is that you have the ability, the flexibility to take advantage of what's going on in the world when it happens. And none of this arbitrage works until you actually start borrowing money. So I just want to tell you that. When you're not borrowing money out of the policy, it's actually getting advantage of the full growth of the market up to, in this case, a 13.5% cap. All right, so these are the big three. These are the big three reasons why these products are so much more competitive than all the other things that are out there, and that's why it works so well when I show you in the Last Great Tax Saver how this all works. Right? So why is this the best retirement program? I'm going to summarize this. Compared to other programs, there's no additional cost today to start their own program. People are putting the same money in. It includes immediate permanent life insurance benefit, provides 25 to 40% more income at retirement tax-free. There's 0% downside risk. The floor on this product that we just showed you is 0%. The cap is 13.5. Annual reset captures and retains all the gains, all your tax-deferred gains. There's 0% income tax on the income, and there's also 0% tax on the original capital when you take it out. So everyone can qualify with no limits on contributions. That's the other thing. When you pick an employee, if you want to do a bonus program, you're not confined to say I can only give this guy $5 grand or $6 grand or $7 grand. I can give him 50 grand, provided we're not outside the bases as far as what we would call too much compensation. But essentially we can do that. All right, and there are no penalties for early withdrawal. So if the employee gets this program and he gets in a jam 5 years from now, somebody gets sick, something happens, his house burns down, whatever it is that goes on, he can have access to the money if he needs it. It's there waiting for him. If he takes it out, it won't be there for retirement, granted, but he can still get it. And he can still take it out 5 years from now or 6 years from now when he takes it out, and he can still borrow it out and still have access to the arbitrage and make money on the money he takes out. So he can do that early on, not just later on. So the idea behind this is that this is a program that can really help them all the way through the rest of their lives, basically. And it's not just life insurance if you die. And that's what you have to get people to understand. This is living insurance in case you live. So that's the program that we have available for you. All right? So I'm going to turn this over to Doug right now and let him finish up with all these nice little things he's going to talk about. Bye.
Okay, great. Hey, thanks, Louis. That was perfect. When you do business with Ogletree, and that's what we're here for today, we're asking you to do your business with us. You're not going to take a haircut. We're going to give you the top contracts that are available. The sales material, the software, these marketing videos. If you go to IULWorks.com, that's IULWORKS.com, that's going to give you an idea of some of the things that are available to you. But this was more of a marketing webinar here. Every Tuesday, or most Tuesdays, we have a training webinar, and that's when we kind of dial down a specific concept like the bonus program, and we throw out exactly how it works, how you would talk to a business owner, how you'd set it up. That's for our licensed agents. So, if these are things that you're interested in, you really need to get contracted with us and start working with us. We talked a little bit about the awards and the trips and the contest. Marketing, lead list, that's another thing that we can help you with. But right right now, for the next 10 days, if you get your contracting in, Louis is going to get you one of the videos that you saw at the front. We're going to email that out to everybody. So that's very important to get that video for free. But at the same time, if you're new to us, and not only do you get a video, if you turn in a case and get that case placed within the next 10 days, if you turn it in the next 10 days with your contract, we're going to give you a $50 Outback steak card. So just another incentive. If you've got a case you're working on, let us get a crack at it. It's not going to hurt you. So, guys, again, thanks for being on our webinar today. We're going to follow it up with an email and the items that we talked about here. And, again, thanks, Louis. Thanks. That was great. And, guys, we look forward to talking to you. Give us a shot at your next case.